Many people hear the term gambler's fallacy and immediately picture a dimly lit casino. They imagine someone hunched over a roulette table, muttering about how red is due after a long string of blacks. This image, while evocative, is far too narrow. It confines a widespread cognitive bias to a specific, somewhat stereotyped environment. The truth is, this particular error in thinking is not the exclusive domain of those who wager on games of chance. It is a subtle, pervasive feature of human cognition, one that can influence decisions in boardrooms just as easily as it can at the betting shop. Understanding this broader reach is the first step towards mitigating its often costly effects on our judgment. Our minds are wired in ways that make us susceptible. So, what exactly is this gambler's fallacy? At its core, it is the mistaken belief that if a particular event occurs more frequently than normal during the past, it is less likely to happen in the future. Conversely, if an event occurs less frequently than normal, it is perceived as more likely to happen soon to balance things out. Consider the humble coin flip, a classic illustration. If you flip a fair coin and get heads 5 times in a row, the gambler's fallacy whispers that the next flip is surely more likely to be tails. The coin, however, has no memory. Each flip is an independent event, with the probability of heads or tails remaining steadfastly at 50-50, regardless of previous outcomes. It's a simple concept, yet its implications are profound. This bias doesn't discriminate based on intelligence, education, or professional standing. It quietly influences the thinking of individuals across all walks of life. From students expecting a different type of question on an exam because the last few were similar, to loan officers subtly influenced by a recent string of defaults or approvals, the fallacy operates under the radar. It taps into our intuitive, fast-thinking System 1, which often prioritizes coherence and pattern-making over statistical reality. This system is incredibly useful for quick judgments, but when faced with genuinely random or independent events, its shortcuts can lead us astray, sometimes with significant consequences. We see what we expect to see, or what feels right. The danger lies in this underestimation of its reach. Believing it's a flaw only for gamblers allows it to fester in other, often more critical, decision-making arenas. When we fail to recognize its presence in our own thought processes, especially in fields like finance, medicine, or even law, we open the door to errors that can have far-reaching impacts. The illusion of predictability in random sequences is a powerful one. It provides a false sense of control or understanding where none actually exists. The world is often messier and more random than our pattern-seeking brains would like us to believe, leading to a fundamental mismatch between our intuitions and reality. The financial world, with its sophisticated models and highly paid analysts, might seem immune to such a basic cognitive error. Yet Wall Street is surprisingly susceptible to the gambler's fallacy. Traders and investors often make decisions based on recent market trends, implicitly assuming that a period of gains must be followed by a correction, or that a stock that has underperformed is due for a rebound. This thinking mirrors the casino patron expecting black after a run of reds. The stakes, however, are considerably higher than a few poker chips. Entire economies can feel the ripple effects of these ingrained biases when they manifest on a large scale, showing how easily human psychology can override complex algorithms. Consider the lead-up to the 2008 financial crisis. For years, housing prices in the United States had seen an unprecedented climb. A pervasive belief took hold that this trend would continue indefinitely, or at the very least, that a significant downturn was highly improbable across the entire market simultaneously. Some may have felt that after such a long run of positive returns, a major correction wasn't due yet. Or conversely, those betting against the market felt a crash was increasingly overdue based on the length of the boom. The complex financial instruments built upon these mortgages amplified the risk, but at a fundamental level, the failure to appreciate the potential for independent negative events to correlate, or for a long-running trend to reverse sharply, played a part. Another stark example is the collapse of long-term capital management (LTCM) in 1998. This hedge fund was managed by renowned academics including Nobel laureates who developed sophisticated models based on historical data. Their strategies relied heavily on the assumption that market deviations would revert to the mean, a financial cousin of the gambler's fallacy. They believed that certain spreads between financial instruments were too wide and were due to narrow. When a series of unforeseen global events occurred, these spreads widened further instead of correcting as expected. The fund's models, which had not anticipated such extreme prolonged deviations, led to catastrophic losses, nearly destabilizing the global financial system. The lesson from these episodes is sobering. Expertise and intelligence are not foolproof shields against cognitive biases. The pressure of high-stakes environments, coupled with the human desire to find patterns and predictability, can lead even the sharpest minds to misinterpret random fluctuations or to underestimate the probability of rare events. The financial markets are complex systems, but the human minds navigating them are prone to the same simple errors that plague us in everyday life. Recognizing this vulnerability is crucial for building more resilient financial systems and for individual investors trying to make sound decisions for their future. The past does not always dictate the future with the certainty we crave. The gambler's fallacy isn't confined to casinos or the intricate dance of stock tickers. Its tendrils reach into many corners of our lives. Think about sports betting, a domain rife with this particular bias. A fan might believe their favorite team, after a string of losses, is due for a win, irrespective of the current opponent's strength or their team's actual form. Similarly, a batter in baseball who has struck out several times in a row might feel they are due for a hit, as if the universe keeps a ledger that must be balanced. This expectation of an upcoming corrective event, purely based on past independent outcomes, is the fallacy in action, often leading to misplaced bets and emotional roller coasters. Even in the realm of personal experiences like dating or job hunting, the fallacy can color our expectations. Someone who has experienced a series of unsuccessful dates might start to believe that the next person they meet is statistically more likely to be the one, simply because they've endured so many disappointments. It's as if a cosmic quota of bad dates needs to be filled before a good one can appear. Similarly, after several job rejections, an applicant might feel that an offer is due, overlooking the independent nature of each application and interview process. While perseverance is admirable, basing one's emotional outlook or future expectations on this fallacy can lead to repeated frustration when reality doesn't conform to these imagined balancing acts. But why do we, even intelligent and rational individuals, fall into this trap so readily? The answer lies deep within our cognitive architecture. Our brains are magnificent pattern recognition machines. This ability has been crucial for survival, allowing us to learn from experience, predict threats, and make sense of a complex world. However, this strength can become a weakness when we encounter true randomness. System 1, our fast, intuitive thinking process, tends to see patterns and causal links even where none exist. It seeks coherence and narrative, sometimes imposing order on chaotic data. This is why a string of similar outcomes feels like it'd be broken. This inherent drive to find meaning and predictability is powerful. We are uncomfortable with the idea that many events are simply the product of chance, independent of what came before. The gambler's fallacy offers a comforting, albeit false, sense of understanding and control. It makes the unpredictable feel a little more predictable. It's a glitch in our otherwise remarkably effective mental software, a reminder that our intuitions about probability can often be misleading. Understanding this innate tendency is the first step towards consciously overriding it when the stakes are high or even when they are just personal. To avoid the siren call of the gambler's fallacy, the most crucial step is to consciously recognize when an event is truly independent of previous ones. This requires engaging our more deliberate, analytical System 2 thinking. We must actively ask ourselves, does the outcome of this event genuinely depend on what happened before? For a coin flip, a roulette spin, or the gender of the next baby born in a hospital, assuming no underlying biological factors for a specific family, the answer is almost always no. The past outcomes have no physical bearing on the next. Internalizing the concept of statistical independence is paramount. Another vital strategy is to actively question our gut feelings and assumptions, especially when a strong intuition arises about an outcome being due. When you feel that certainty, pause and reflect. Is this feeling based on logical analysis and actual probabilities, or is it an emotional response to a perceived pattern in a random sequence? Keeping records or logs of events where appropriate can sometimes help to demonstrate the true randomness over time, dispelling the illusion of corrective patterns. For instance, tracking actual coin flip sequences can reveal that long streaks are not always corrected immediately, and short-term perceptions of imbalance often fade into the expected probabilities over a larger sample size. Embracing uncertainty and the role of chance can also be incredibly helpful. Life, and many of its constituent events, are inherently unpredictable to a certain degree. Trying to force a narrative of balance or correction onto random sequences is a recipe for flawed decision-making. Instead, focusing on process and sound reasoning, rather than solely on short-term outcomes, can lead to better choices in the long run. This means accepting that sometimes, despite making the right decision based on available information, a statistically unlikely outcome can still occur. This is not a failure of judgment, but simply the nature of probability. Ultimately, understanding the gambler's fallacy is not just an academic exercise, it is a practical tool for improving our decision-making capabilities in virtually every aspect of life. From personal choices to professional judgments, recognizing this cognitive bias allows us to approach situations with greater clarity and rationality. By consciously engaging our analytical minds and questioning our intuitive leaps, we can steer clear of this common mental pitfall. The world will still contain randomness and uncertainty, but our navigation through it can become significantly more astute, leading to fewer choices we might later regret, simply because we mistook chance for a predictable pattern.